Yo, hold up a second. Remember back in 2021 when everyone was laughing at XRP holders? When the flip became the biggest crypto meme and every influencer treated it like hopium? Well, I need to tell you something that's going to absolutely blow your mind. I've been creating cryptocurrency content for years, analyzing market trends, interviewing industry insiders, and watching this space evolve. And honestly, I completely underestimated what Ripple was building. While I was focused on Ethereum gas fees and Bitcoin dominance, something far bigger was happening behind the scenes. If this is your first time here, I break down institutional-grade crypto opportunities with data-driven analysis that actually matters for long-term wealth building. Smash that like button if you want more content like this, hit subscribe, and drop a comment, because what I'm about to show you might completely reshape your investment thesis. The numbers that changed everything. All right, let's talk about what actually went down in November 2025. Ripple closed a $500 million funding round. Not from crypto VCs, not from speculative hedge funds, from Fortress Investment Group and Citadel Securities. Now, hear me out. Citadel Securities processes 40% of all US retail stock trades. They're the market makers who literally keep Wall Street functioning. These aren't gamblers, these are the people who built the plumbing that moves trillions daily. For Citadel to invest $500 million in Ripple at a $40 billion valuation, that's not a bet. That's validation that blockchain settlement infrastructure has crossed from experimental technology to essential financial architecture. But here's where it gets absolutely wild. Ripple didn't just raise money. They've been on a $4 billion acquisition spree throughout 2025, systematically buying companies that provide custody, prime brokerage, and treasury management services. Think about this. They acquired Hinro for $1.25 billion, instantly giving them institutional-grade prime brokerage capabilities that compete directly with Genesis and Galaxy Digital. This isn't a crypto company anymore. This is a financial infrastructure powerhouse that's rebuilding global payment rails from the ground up. And they're doing it while banks are actively partnering with them rather than fighting them. The story nobody's telling. Let me share something personal. A few months ago, I was researching cross-border payment corridors for a video on remittances. I started digging into how money actually moves between countries, not the theory, but the actual mechanics. And what I discovered honestly shocked me. Traditional correspondent banking is insane. A major bank processing $10 billion in annual cross-border payments maintains $1 to $2 billion just sitting in nostro accounts, dormant capital, doing nothing except waiting for payment instructions. Imagine tying up over $1 billion, earning basically zero return just to facilitate payments. The capital inefficiency is staggering. Then I looked at what institutions using Ripple's on-demand liquidity report. 65% capital requirement reduction. Let me break down what that actually means in dollars. A bank with $1 billion locked in nostro accounts suddenly frees up $650 million. At a 10% return on capital, that's $65 million in additional annual income. That's not theoretical efficiency improvements. That's pure profit created by eliminating infrastructure waste that's existed since the 1,970 seconds. And here's the mind-blowing data I promised. In a single day during August 2025, the XRP ledger processed 844 million XRP, a 500% spike in payment activity. That wasn't retail speculation. That was institutional money executing massive treasury operations and cross-border settlements at scales impossible on traditional rails. The geographic domination nobody expected. This changes everything. ODL volume surged 41% quarter over quarter in 2025, with new corridors in Brazil, Singapore, and the UAE driving over $2.7 billion in monthly volume through just these three markets. Let me paint a picture for you. Brazil represents Latin America's largest economy, with millions of expatriates sending remittances home. The Brazilian real has massive volatility, and traditional correspondent banking for real transactions is expensive and glacially slow. ODL solves this by eliminating pre-funded real accounts while providing settlement fast enough to minimize foreign exchange risk. Singapore? That's the gateway to Southeast Asia, Thai baht, Malaysian ringgit, Indonesian rupiah, Philippine peso. One hub, dozens of corridors. The Monetary Authority of Singapore runs one of the world's most sophisticated cryptocurrency regulatory frameworks. So Singaporean adoption means institutional-grade compliance validation. The UAE connects South Asia, Africa, Europe, and East Asia. Dubai is a massive transit point for international commerce, plus millions of expatriate workers sending remittances home. And the dirham's peg to the US dollar provides currency stability that reduces volatility concerns. These three markets alone represent $32 billion in annualized volume from just the newest corridors. That's not pilot programs. That's production-level deployment at serious scale. The central bank validation that shocked me. Now pay close attention because this next part is absolutely crucial. Over 20 central banks are studying, piloting, or integrating XRP ledger infrastructure for CBDC issuance and cross-border interoperability. The Royal Monetary Authority of Bhutan is piloting CBDC infrastructure with Ripple. Hong Kong's Monetary Authority ran pilots with Bank of China, HSBC, Standard Chartered, Visa, MasterCard, and Alipay, exploring asset tokenization and instant payment rails. Singapore's Monetary Authority conducted a successful live trial in November 2025 using shared ledger infrastructure for tokenized asset settlement with programmable payment logic. Think about this for a second. Central banks are the most conservative institutions on earth. They cannot tolerate operational failures in monetary infrastructure. When central banks select your technology to power sovereign digital currency projects, that transcends any retail hype cycle. These aren't publicity stunts. These are production frameworks that could define how digital currencies interact globally for the next 50 years. The technical reality check. Buckle up. The XRP ledger processed 642 million transactions throughout 2024, jumping from 520 million the previous year. By Q1 2025, the network averaged over 2.14 million daily transactions, with daily volume hitting 1.7 million by Q3, a 94% quarter-over-quarter increase. And here's the kicker. This isn't testnet activity or wash trading. Approximately 68% of XRP transactions are now automated or executed via smart transaction scheduling tools. This is treasury management systems, payment processors, and institutional settlement workflows where transactions execute based on predetermined schedules without human intervention. The ledger can theoretically handle 1,500 transactions per second with 3 to 5 second settlement finality. Internal Ripple stress test in April 2025 demonstrated temporary throughput exceeding 100,000 TPS under laboratory conditions. For comparison, Swift's pilot project for instant settlement is capped at 10,000 concurrent TPS. XRP Ledger isn't competing with Swift anymore, it's already technically superior, and institutions are figuring that out. The stablecoin play nobody saw coming. This might blow your mind. Ripple's RLUSD stablecoin crossed $1 billion in market capitalization within its first year. For context, the stablecoin market is dominated by Tether at $120 billion and Circle's USDC at $30 billion. Reaching $1 billion in a year makes RLUSD one of the fastest growing stablecoins in crypto history. But here's the genius part. The two-token system where XRP handles cross-border bridging and RLUSD provides stable settlement addresses different institutional needs simultaneously. Payment corridors with deep XRP liquidity optimize for maximum cost efficiency. Corridors with regulatory uncertainty can use RLUSD-based settlement to avoid compliance questions around volatile crypto assets. The MasterCard collaboration with Gemini and Ripple testing RLUSD on the XRP ledger, that's potentially game-changing. MasterCard processes billions of transactions annually for thousands of financial institutions. If MasterCard successfully integrates RLUSD and XRP ledger functionality into payment processing infrastructure, it creates instant distribution across their entire banking network. The ETF, Tsunami creating institutional access, I did not see that coming. Total assets under management across spot XRP ETFs exceeded $1.9 billion within the first month of trading. JP Morgan projects total XRP ETF inflows reaching $3.5 billion within 6 months, potentially accounting for 7% of the global cryptocurrency ETF market. Cathie Wood's ARK Invest specifically called XRP the most credible institutional altcoin of 2025, based on its unique combination of regulatory clarity and real-world usage. These aren't crypto influencers. These are institutional investment managers with billions under management, conducting exhaustive due diligence before public endorsements. And here's where the feedback loop gets interesting. As institutional investors allocate capital to XRP ETFs, the increased capital inflow provides liquidity depth that makes XRP more attractive for payment applications. Financial institutions using XRP for cross-border payments benefit from deeper liquidity pools that reduce slippage and improve execution quality. That improved operational performance validates the investment thesis, creating a virtuous cycle where investment demand and operational demand strengthen each other. And you guys, I have a special trick for you which nobody seems to be using, and I cannot wrap my head around why. Because if you sign up through my link down in the description onto the BuyDefi exchange, you get a 10% deposit bonus. And now stay with me here. Now, here comes the important part. If you have any trading capital on any other exchange and you move it to your newly created BuyDefi account, you get on top of your capital. You moved another 10% extra trading capital. As an example, if you move or deposit $10,000 to your account, you get a $1,000 for free. And here is why this is possible. BuyDefi makes money on trading fees. The more capital you have, the more you trade. The more you trade, the more they earn. So they're literally investing in your trading activity by giving you extra capital up front. And unlike other platforms where bonuses are in the 1 to 3% range, BuyDefi's bonus is a full 10%. I am not kidding. I really don't understand why nobody is doing this. To me, it really seems like people sometimes are too lazy or just don't like free money. I kindly ask you to pause this video and take your time to make an account. You can thank me later in the description of this video. The revenue reality nobody discusses. Light bulb moment. Ripple's Q2 2025 revenue hit $2.1 billion, representing 32% year-over-year growth. That's over $8 billion annualized. Let me put this in perspective. Western Union generates approximately $5 billion in annual revenue, serving retail customers with fees averaging 6 to 7%. If Ripple's annualized revenue approaches $8 billion, they're already rivaling traditional competitors despite focusing on institutional clients and charging much lower percentage fees. This revenue isn't from token sales. It's operational income from banks and payment providers actually using the infrastructure for production-level transaction processing. That's the difference between speculative crypto projects and legitimate financial technology companies' sustainable revenue from operations. The acquisition strategy that changes everything. And here's where it gets wild. Ripple acquired Palisade for digital asset custody, launching Ripple Custody with institutional-grade cold storage and insurance coverage. They acquired G-Treasury, bringing enterprise treasury management software that allows corporate treasurers to manage fiat and crypto liquidity from a single dashboard. This vertical integration is brilliant. A company can initiate cross-border payments in G-Treasury, have them automatically route through ODL if that's optimal for cost and speed, and receive real-time settlement confirmation without understanding the underlying blockchain mechanics. That abstraction of complexity is essential for mainstream enterprise adoption. Decision makers evaluate payment solutions on cost, speed, and reliability, not the underlying technology stack. The institutional tipping point, the 92% client retention rate, tells the real story. Institutions that implement Ripple's technology continue expanding usage rather than testing and discontinuing. That's the strongest validation of product market fit in enterprise software. 38 new institutional partners in Q1 2025 alone, including major banks in Singapore and Canada. By Q3, institutional payment volume grew 53% year over year, the fastest growth rate in platform history. Approximately 40% of RippleNet's 300-plus financial institution partners now actively use XRP for on-demand liquidity transactions. This percentage represents a critical threshold where network effects begin compounding exponentially. The price disconnect that frustrated everyone. Now, here's the brutal truth. Despite all these institutional developments, XRP's price performance has been disappointing. Record wallet creation, 41% quarterly volume growth, massive ETF inflows, and the price barely moved. Why? Institutional ODL usage involves holding XRP for 3 to 5 seconds during settlement. That creates transaction demand, but not investment demand. Plus, Ripple continues releasing XRP from reserves through programmatic sales, creating selling pressure. But here's what most people miss. Market makers must maintain substantial XRP positions to provide liquidity enabling large transactions without slippage. As monthly ODL volume scales from 2.7 billion to potentially 10 billion, 50 billion, or higher, liquidity requirements scale proportionally, creating sustained structural demand. This isn't about weekly price pumps. This is about multi-year trends where operational adoption gradually absorbs supply and establishes higher baseline demand levels. The final reality. The years 2024 and 2025 represent the inflection point where XRP transitioned from controversial crypto project to recognized payment infrastructure. The combination of regulatory clarity, ETF approvals, $500 million funding at $40 billion valuation, stablecoin adoption, CBDC pilots, and sustained revenue growth creates a qualitatively different situation than existed even 2 years ago. Brad Garlinghouse publicly projected XRP could capture 14% of Swift's transaction volume within 5 years. At Swift's current $150 trillion annually, that's $21 trillion in annual flow through XRP-based corridors. Every time an institution uses XRP to bridge a payment, it creates real buy pressure that doesn't vanish. It compounds as adoption scales. Smash that like button and subscribe to Crypto Talk right now because Ripple isn't in pilot mode anymore, they're in full deployment mode. While everyone watches meme coin TikToks, XRP is becoming the invisible protocol layer for international finance, one institutional settlement at a time, building toward the moment when correspondent banking is already obsolete and most people won't even realize the rails changed underneath them.